These days, people have been talking a lot about P, price to earnings ratio. So one important myth I wanted to decode here is all about the earnings of the company. So before getting into earnings, price to earnings ratio is nothing but the price of the particular stock divided by the earnings of that company. So this earnings is nothing but the total profit after tax of the company divided by the number of shares outstanding. So that will give the earnings per share. But then higher PE means you are telling that it is highly overvalued, and if it is a lower PE like below 15, it is considered undervalued. But then is this earnings correctly calculated? So now getting into the earnings. So it is nothing but profit after tax. So how you derive this profit after tax in the balance sheet? You have revenue. So whatever sales the company has done, you have expenses, the raw material cost, salary for the employees, fixed cost and variable cost. So all this deducted from the revenue, you will get the EBIT, earnings before interest, tax and even depreciation and amortization. After that, you will deduct the interest. So you may have some loans taken. So you have done the project on credit. You have taken loan from a lender, a bank. So you have to pay interest. So that is deducted from that. Then you have amortization and depreciation. So maybe depreciation is like you have a machine. So it is having a life. So you have bought the machine for 10 lakhs and it is having a total service life of 10 years. So you will divide that amount by 10 years by particular calculation and you will split that buying amount over the year of 10 years. So that amount will be deducted again from the revenue. Then amortization also similar to depreciation, you deduct from revenue. So all these expenses, depreciation, amortization, interest, after deducting all these things, you will get what you call as profit after tax. So the question here is that the PAT, whatever you are mentioning as profit after tax, is it real cash? Is that amount totally available for the company to go for next capex cycle or spend or to give it as dividend to the shareholders? So is that total profit after tax available as real cash? So for that, you should not look at the earnings. You should look at the cash flow statement. So in the cash flow statement, you have cash flow from operations. So you have to always ensure that the cash flow from operations is always more than the profit after tax. So even if you see the cash flow statement, so in that cash flow from operations gives you the real cash which is available for the company because you have working capital consideration in that. So from the EBITDA, you will deduct the working capital and you will derive other non-cash items and you will derive at the cash flow from operations. This cash flow operation should be at least 70% of the EBITDA. And also this cash flow from operation should be greater than the PAT. And also you should look at the cash conversion cycle. So is the company able to convert their revenue into real cash? Time which the company takes from spending its money for raw materials, making finished goods, selling it to the customer, getting money back, hence getting real cash. So now guys, you should remember that it is real cash you should look at, not just the figure of earnings, wherein price to earnings will totally misguide you. You should always concentrate on cash flow statement, which is available in the annual report or else even in every app, wherein you should look at the cash flow from operations, compare it with PAT, and also look at the EBITDA, and also you should look at the cash conversion cycle. This will give you a real picture of whether the company is making real cash and is it able to deploy it for expanding its business and make real wealth for you. See you in next video. Till then, happy investing.